All right, welcome back. If you turn on the news right now, you're seeing a total circus. Talking heads in expensive suits dissecting every single syllable that comes out of the Federal Reserve or some committee in DC. They're obsessing over dot plots, meeting minutes, and whether the Fed chair looked hawkish or dovish at the podium. And the parlor game of who will be the next Fed chairman? It's getting hotter every day. They treat the Fed like it's a holy temple, and the chair is the high priest. I'm here to tell you that on the professional bond desks, we're barely even paying attention. While the retail world is caught up in the Fed drama, the real money, the traders and portfolio managers taking market swings every day, are busy ignoring the noise. Why? Because we know something the media won't tell you. The Fed has lost the steering wheel. In January 2026, the Federal Reserve isn't the master of the universe anymore. It's a passenger in a car that's heading toward a $38 trillion brick wall. Today, I'm going to show you why bond traders are ignoring the drama, why the bartender is actually trapped in a debt cage, and how you can spot the real moves before the news even reports them. Every time the Fed chair speaks, the stock market does a little dance. A measured tone sends tech stocks up. A stern warning sends them down. But look at the bond market, the tape. The tape doesn't care about feelings. It cares about math. Right now, the Fed is trying to tell us they are in control of inflation. They're saying they'll keep rates higher for longer to fight the new wave of tariff-driven price spikes and the affordability apocalypse. But look at the 10-year Treasury yield. While the Fed is screaming that short-term rates need to be restrictive, the market just pushed the 10-year higher, currently sitting at 4.27%. And through all the drama of the Fed and the chairman, guess what? The 10-year yield has been in a tight trading range since Labor Day weekend. In other words, the bond market can see right through the nonsense. This is what we call the credibility gap. In the bond bar, when the bartender says, "I'm closing the tap," but everyone at the bar is already ordering another round at a lower price, it means nobody believes the bartender actually has the guts to kick them out. Bond traders are ignoring the Fed's drama because they can see the underlying plumbing is leaking. We aren't trading on what the Fed says, we're trading on what the Fed is physically capable of doing. And right now, they are pinned. Here is the dirty secret of 2026. The Fed doesn't work for the economy anymore. It works for the Treasury. As of last week, the U.S. national debt hit $38.43 trillion. That's not just a big number, it's a fiscal heart attack. We are currently adding $8 billion to the debt every single day. Over the past year, that's $2.25 trillion in new debt, and we aren't even in a recession yet. The interest expense on that debt is now north of $1.12 trillion a year. Think about that. We are now spending more on interest than we are on the entire U.S. military budget. This is what's known as fiscal dominance. Imagine you're the Fed chair. You want to keep rates high to kill inflation. But every time you keep rates high, you're making the government's credit card bill go up by billions of dollars every month. If you keep rates high for too long, you literally bankrupt the person who hired you, Uncle Sam. Bond traders know this. They see the average interest rate on the debt has climbed to 3.36%. They know the Fed is trapped. They can't keep rates at 5% forever because the math of the national debt won't allow it. So when the Fed chair talks tough at a press conference, bond traders just roll their eyes and go back to their Bloomberg terminals. They know the bartender is staring at a bill he can't pay. While the media is busy dissecting Fed speeches, the real action is happening at the maturity wall. Think back to 2021. Money was basically free. The Fed's free money machine was pinned to the max. The government was handing out checks to anyone who could fog a mirror. Corporations borrowed trillions of dollars at 2% or 3% interest. They thought the party would never end. But those loans weren't a gift. They were a contract with an expiration date. And for many of those companies, that date is 2026. This year, nearly $1.8 trillion in corporate and commercial real estate debt needs to be refinanced. These aren't just zombies at the back of the bar. These are tech companies, retailers, and multifamily developers. They have to hand back their 3% debt and take out new loans at 7% or 8%. If the Fed keeps rates high, these companies hit the wall and explode. If the Fed cuts rates to save them, inflation comes roaring back. Bond traders are ignoring the Fed drama and focusing on the credit spreads. We're watching to see who hits the wall first. The Fed can talk all they want about soft landings, but the maturity wall is a hard, physical reality that doesn't care about speeches or vibes. You want to know why everyone is angry, other than the social media algos stuffing brain rot down our throats? Look at the 30-year mortgage rate. It just settled near 6.06%. While that's down from the 7% highs of last year, it's still triple what people were paying in the golden era of 2021. Here is the kicker. For the first time in modern history, more Americans hold mortgages with rates above 6% than those who hold rates below 3%. The golden handcuffs are finally starting to rust through. The bond market is looking at the housing sector and seeing a liquidity ghost town. Homeowners are trapped. They can't afford to sell because they'd have to double their interest rate. Buyers can't afford to buy because the prices haven't dropped to match the yields. The Fed drama says rate cuts are coming, but the government is already getting desperate. Have you seen the latest order for Fannie and Freddie to buy $200 billion in mortgage bonds? That's the Bond Godzilla trying to force rates down because the Fed won't do it. The bond market is already pricing in a world where affordability is dead for a decade unless the government literally takes over the pipes. Here's something the drama watchers completely miss. The rest of the world is starting to panic. For decades, countries like Japan and China were the patient lenders to the US. They bought our treasuries because they were the safest bet in the world. But in 2026, the game has changed. Japan is finally raising its own interest rates to save the yen. Their 10-year yield has literally doubled. China is diversifying away from the dollar. This is a global margin call. When the biggest buyers of our debt stop buying, the bond market has to find someone else to take the paper. And the only way to attract new buyers is to offer higher and higher yields. This is why the 10-year yield is spiking, even when the Fed says they want to be patient. The Bond Vigilantes aren't just in New York, they're in Tokyo, London, and Beijing. They are looking at the $38 trillion debt and saying, if you want me to lend you money, you're going to have to pay me more for the risk. The Fed can hold all the meetings they want, but they can't force Japan to buy our bonds. This global shift is the real Godzilla in the room, and it's completely ignoring the drama in DC. There's another reason we ignore the Fed. They don't even know what's happening in half the market. After the 2008 crash, regulations made the big banks safer. But the risk didn't disappear, it just moved across the street to the shadow bar. I'm talking about private credit. In 2026, the private credit market has exploded past $2 trillion. These are private loans that are completely unregulated. The Fed doesn't see them on their balance sheets. The rating agencies are still giving them investment grade stickers based on the mirage, math that hasn't been tested in a real recession. Bond traders are looking at this shadow bar and seeing a ticking time bomb. These private funds claim their assets are stable because the price hasn't moved. Bro, the price hasn't moved because no one is trading it. It's like saying your house is worth $1 million because you won't list it for sale during a Category 5 hurricane. The Fed can move the target rate all they want, but if the shadow bar loses liquidity, the whole system seizes up. Traders are watching the plumbing, while the media is watching the podium. So, why are we ignoring the Fed? Because we're in a game of chicken, and the Fed isn't the one with the steering wheel. The market is. In my 20 years trading in every different market imaginable, I've learned one thing. The Fed always follows the bond market. They don't lead it. They wait for the market to move, and then they hold a press conference to pretend it was their idea all along. Right now, the 10-year Treasury is signaling that the Fed is either going to have to let inflation run hot to save the government, or let the economy break to save the dollar. The market is already pricing in the policy error. Bond traders aren't listening to the drama because they're already trading the aftermath. If you want to survive 2026, You have to stop being a drama consumer and start being a math consumer. Stop listening to the Fed chair's tone. Start watching the 10-year Treasury yield. If it's rising while the Fed is talking about neutral rates, the market is telling you the Fed has lost control of the long end. Remember Liberation Day last April? That tariff rollout caught everyone off guard. The S&P hit a correction in just 5 days. Kinda scary, but natural. What spooked the policymakers in DC? The 10-year spiked and risked getting out of control. That is what spooked markets. That's when things break. Watch the maturity wall. Keep an eye on the distressed asset sales in the multifamily sector. That's where the real pain is going to show up first. Ignore the soft landing myth. The math of $1.1 trillion in interest and $1.8 trillion in maturing debt doesn't allow for a soft landing. It allows for a reckoning. The bartender is trying to keep everyone calm while the bar is literally sinking into the ocean. The pro traders have already found the lifeboats. They aren't listening to the band, they're watching the water level. The reason we ignore the Fed drama isn't because the Fed is irrelevant. It's because the Fed is predictable. They are a prisoner of their own bad decisions and the government's massive debt. In the bond bar, the person with the most money makes the rules. And right now, the Bond Vigilantes have more money and a better memory than the Federal Reserve. I'm the Bond Bro. Catch you in the next episode.